Bring back our panel, Jim Paulsen and Tim Urbanowicz, excuse me. Jim Paulsen, do you think that this is a message that's going to sustain the market for a little while? Or are we just going to be kind of going data point to data point and testing the soft landing proposition against what's coming in?
Well, I think it's bigger than just the Fed announcing rate cuts today. I think by doing that, they opened up a lot more positive forces for the stock market that just haven't been there. This is the only bull market in post-war history where the Fed has been tight throughout its entire existence. Normally, the Fed is easing before the bull even starts. So in some ways, I think the Fed in doing this is taking us back to the start of the bull, and they're going to ease rates, which also means bond yields are going to come down for the first time, which also means monetary growth is going to start speeding up even more than it has, really for the first time. And in addition to that, we still have positive real GDP growth. We still have the power of disinflation. And if you put all these together, something we haven't had at all yet, we're going to get a rise in private sector confidence. Consumer and business confidence, I think, is going to start to lift as well, much like the feel of a brand new bull market. And it's all of that together, which normally brings a broad market advance when you start a new bull. And I think that's what we're also seeing. So, yeah, I think it isn't just about the Fed doing 25 or 50. Mm-hmm. It's the intention to ease monetary policy that's opening up a brand new degree of support for stocks that I think is going to persist well into next year.
I mean, if that all comes together, we might be talking about overheating in a frothy market before too long, I guess. Tim.
We could.
Yeah. Tim, on a practical level, how does an investor, I guess, try to navigate this type of scenario or the range of scenarios that might be out there? Because it's going to be hard to get people to look away from the idea that we're still on some level have some late cycle dynamics here as well.
Well, that's exactly it, Mike. And I think what's still important to be focused on is just like there's a lag with interest rate hikes, there's going to be a lagged impact of interest rate cuts as they come through. So investors still need to prepare for a slowdown. Our financial advisors are turning heavily toward buffer strategies, really to hedge volatility as they head into the back half of the year. But we also think it makes a lot of sense right now to focus on pockets of this market where demand is not going to be impacted by a slowdown in economic growth. Think about some of those AI infrastructure names where companies are not going to be pulling back spending there. They should be able to maintain good margins, firm margins. And then when we look at the other side of the house, you look at some of these retail stocks. We really think that it's important to focus on stocks that are actually willing to drop prices to maintain consumer demand. This was a very undercover theme that we saw playing out throughout the Q2 earnings season. You look at a company like Target, where they were dropping prices, demand was very strong, their customers were coming in for a bargain. And then on the other side of the equation, you look at like a Home Depot, where they were trying to keep prices high, they're trying to maintain margins, and the market didn't like that too much. So we think that's really important right now, just given the slowdown that we think is in store for the next 6 to 12 months.